Hello friends, in today's video, we will discuss the concept of the fair value gap. The fair value gap represents abrupt gaps in price, indicating upward or downward movements. This region signifies an imbalance in price, revealing an unsteady development in the market. The market never favors unbalanced price movements and takes action to fill the areas where imbalances occur. In our video, we will delve into this topic, exploring how the price reaches the region known as the fair value gap and how it departs from this area. Additionally, we will examine how order blocks form just below or above this region. Let's get started right away. Currently, on the screen, we are witnessing a formation known as a fair value gap. Here, after creating an order block region, the price rapidly descends. This descent occurs in a region where there are no orders or an order vacuum exists. Generally, these areas occur after an order block, and this gap region formed after the order block is referred to as the fair value gap. Eventually, this gap region is filled by market movements after a certain period following the order block. In short, we can anticipate that this region will be revisited by the price, allowing us to guide our transactions accordingly. Now, I've provided an example on the screen to demonstrate how the fair value gap region should be drawn. As you can see on the screen, we have a descending region. This region should be drawn from the bottom level of the upward gray candlestick just above it to the top level of the gray candlestick you see at the bottom. The large-bodied black bearish candlesticks in between create the fair value gap region. Here, the imbalanced price movement formed by these black candlesticks will be filled by the market sooner or later. Let's explain what the fair value gap area is with a nice example. When we examine this on an example, let's learn how it works with some formations because no element alone gives the chance to make a successful trade, but with the price action work we will do in combination, we can get out of many transactions profitably. Now there is a downtrend in the Ethereum chart in the daily time frame. Let's look at this example carefully, because we can only understand how many factors come together to make a successful transaction with the example. We see that a double bottom formation has occurred after the downtrend. The double bottom formation indicates the start of an uptrend, but it is not reasonable to enter a buy trade directly without meeting some criteria. It is necessary to wait for these criteria to occur. Novice traders often think they missed this opportunity when they see the price rise after the double bottom formation, but this is not true. You have to be patient for a successful trade. One of the criteria to understand that the market will start to rise again is that there is an upward market breakout in the area that I marked as change of character, as you can see in the middle of the graph. We see that the price rises sharply after the change of character and double bottom formation, and forms four gray, or green, bullish candlesticks. There is a gap between these candlesticks. This gap means that the price breaks out of the order block and rises without any correction. This creates an imbalance in the market. The market does not like imbalanced price movements and closes these gaps sooner or later. Fair value gap is a formation called imbalance and it can be seen with another formation called liquidity void. But in this video, we will focus on the fair value gap topic. In our next videos, we will explain the liquidity void topic, how these formations occur and how we can use them to make a successful trade. And we can call the area formed with the double bottom formation below the fair value gap region where the imbalance occurs, bullish order block. This point now appears on the chart as the lowest point at which the price should potentially rise upwards. It seems highly likely that the price will rise with serious momentum upwards from the fair value gap or order block area. After the formation of both regions, another region called dragon fruit was created, which I marked separately on the screen. Professional traders often love and use this zone. A lot of order entries accumulate here, and with the order entries, the price can increase significantly before entering the order block zone. Of course, these are all possibilities, friends. Please do not consider any of these as certain, but as you know, we always take our position according to the highest probability in our trading and we always try to make more profit in trading. We act accordingly. As you can see on the screen, after the price moves away from these regions, it tests these regions twice again and the price candles visit these regions. And then I want you to notice that the fair value gap region is completely filled. Since the market does not like gaps, there is a 90% probability that it will revisit the area where it rose or fell by creating a gap, so that the price goes stronger step by step in whichever direction it is going, which is a situation that pleases professional traders more. Although sudden rises or sudden falls actually please people who are new to the market, This situation creates a huge imbalance and a big risk in the market.
And by checking the upward movement of the price from the filled fair value gap region together with the high volume columns of the volume indicator we see below, we can see that this rise is not a fake movement. Later, we can enter the transaction from this region, so the volume indicator shows us the strong movement when leaving this region.
The stop loss level can be placed below the fair value gap region or the dragon fruit region or the nearest swing below the candlesticks entered into the transaction. Of course, the place where the stop loss region will be placed is shaped by the risk perception of the trader. With this strategy, after the stop loss region is determined, the fair value gap regions in the upper regions can also be detected and the risk-reward ratio can be expected towards those regions or static risk-reward ratio with levels such as 1/1.5, 1/2, 1/3, 1/5 or even 1/10 can be pursued. And when we look at the price from the daily time range, we can see that it made an extraordinary increase of 76%.
This kind of strategy is really an advanced trading is an important strategy used by professionals in the market.
Now I'm bringing the explanation text about the fair value gap to the screen.
Please read this text carefully and understand it. After that, I want to say goodbye to you until we meet in our next video. In our next videos, I will try to bring as many semi-professional and professional strategies to the screen as possible. Of course, I will include important indicators in such professional approaches, but I will compile many strategies for you without doing direct indicator-based trading. Goodbye.